Hello, everybody. It's Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, aka Mr. Valuation. Here, bringing you another Lessons in Valuation subscriber request series 2-minute drill video. These are just a short, high-level video where subscribers have asked me to look at companies. The one I'm going to feature today is Equinix, which is a data center real estate investment trust. Now, I'm going to first look at it from the metric funds from operations, FFO they call it. You can see the orange line has an F. And you can see the company's had very steady growth in funds from operations, averaging over 23%. However, if I shorten the time frame, you see that it's dropped down to 20%. Now, if I put price on the graph, you can see that the market has been valuing this at a premium valuation. However, due to the recent drop in stock prices, allegedly because of the tariffs, we now see it trading at a much lower valuation. If I use our current valuation line, this has typically been a pretty attractive valuation to buy the stock. There's only a couple of times in this history going back to 2006, the beginning of 2017, where the stock is traded at a lower valuation. Again, if I run it at a full graph, because the growth rate is so much higher, it looks like it's fairly valued. But I like funds from operations because it's a pretty much standardized metric for REITs, but what's become very popular lately is adjusted funds from operations, which is less standardized. Needless to say, this gives us still a very similar picture. And if you look at it from a standpoint of that current valuation, looking at it from an AFFO point of view, it's trading at a valuation that is historically attractive. Now, it's been times when it's been a little cheaper than that, but very rarely can you buy it this cheap. Looking at the forecasting graph going forward, looking at the normal multiple graph of 26 times AFFO, it does look like a buy here with a potential to earn about 20% a year annualized. It does pay a 2.5% dividend, which is not very high relative to REITs. It's primarily a growth REIT, if you will, but it's been very consistent. It's got a great dividend record. It did pay a special dividend back in 2016, but otherwise it normally pays about an $8 dividend. It's grown to almost a $20 dividend by 2026 expectation. So it's an interesting REIT, triple B rated, 53% debt. REITs have high debt. They buy real estate. Anyway, I still think it's a very highly valued real estate investment trust, but it's certainly better than it was even a few months ago. Anyway, it's been Chuck Carnevale, co-founder of FastGraphs. Hope you enjoyed the video. If you did, give me a like, ring the bell, subscribe to the channel, and take a look at subscribing to FastGraphs. Whether you invest in REITs or individual, just C corporation type stocks, FastGraphs is the value investor's best friend, in my opinion. Thanks for watching.